Good afternoon, everybody. My name is Dylan Wahlberg, one of the advisors here on the team here at Secured Retirements. Today, we're going to be talking about the potential tax storm ahead and how you can protect yourself from that. Before we got to jump into things and get started, run through the disclosure here. Nothing we're going to talk about today is meant to be specific investment, tax advice. Everything's subject to change. So that being said, tax-wise, typically we start asking, the families we work with, and even ask yourself if you're on the webinar today, do you think taxes are going to be lower when it comes to your retirement? And the answer to that is, like a lot of things in our industry, is that it depends, but most likely we'll be seeing tax rates going higher. We'll kind of get into that here why today. And the big thing with retirement, you think about the silent partner being the IRS. And if you think back to when you started working and there was this thing, your employer came up to you and said, hey, there's a 401k, you'd be able to put money in there. You're going to get a tax deduction up front because you're working, you're making a wage. Sounded like a great deal. You get to take it out in retirement later on in life when your income's lower because you're not working anymore. You'll be able to take it out at a lower rate, tax rate that is. And a lot of families are finding out here now that that isn't exactly the case the way it was sold back when you started contributing to these 401k and IRA accounts. So what we want to look at is, where are we at right now and really how did we get here as far as just economic or financial aspect here as a country. And really the big thing that we probably all remember March of 2020, we had the coronavirus, all the shutdowns. Trump put into act what's called the CARES Act, which is about $2.2 trillion. He later on followed that up with the $900 billion of stimulus. We also saw $1.9 trillion that Biden put into place in March of 2021, or after he got into the office last fall. The Infrastructure Act, we probably all remember maybe talking about this and debating what infrastructure actually was at the time. But there's another $1.2 trillion that was put into place there. And we start adding up all this money that's been put into the economy and the system here in America. And through the pandemic, we've added about $8 trillion in just government spending, whether it's been the stimulus checks to individuals, to businesses, just overall spending to continue to stimulate the economy. Probably all seen this before as well. We have the U.S. debt clock, which seems to be ticking up every second of every day. Not just necessarily the debt and where that's at, but all the unfunded obligations, all the promises we've made for the future that we have not yet quite allocated any money for. So the question really is, we know where we've, all the stimulus, everything we've gone through the pandemic. We had the national debt that was around $20 trillion before 2020 and the pandemic started. We've added another we're up over $30 trillion now in national debt. So how do we kind of get out from where we're at right now? And really, how is it going to affect your personal tax rate? With that being said, we've added the $8 trillion. Where we're going from here, we've heard the Build Back Better that Biden's been trying to pass. It doesn't look as likely as it maybe did 7-8 months ago, but it's still out there and could end up being yet another stimulus, some more money pumped into the economy to, again, whether it's for climate, kind of whatever the bill is meant for. Basically more spending on top of the spending that we've already had for the last 2 years. All is going to have to be paid for at some point in time. Overall, we're looking at $8 trillion where we're at right now to potentially up to $12 trillion, depending on how everything ends up shaking out, added to the economy over just a short period of time here in the last 2.5 years. So again, the question really is, how are we going to pay for everything? And there's a lot of different options. We could reduce future spending. We could borrow more money on top of what we've already borrowed. We can grow out of it. We could, if the economy takes off, start paying down the debt that way, or we can increase revenue with higher taxes. Or it could be a combination of all things. Typically, the easiest part is going to be to raise taxes at this point. We look at what we do know around tax rates right now is the Tax Cuts and Job Act that was put in place effective starting in 2018 is going to sunset. It's going to be expiring here in 2025. So what that means for us in 2026 is we're going to have higher income tax rates. Capital gains and dividend tax rates are going up as well. The estate tax exclusion, which is at over $11 million, is going to drop back down to the $5.5 million mark as well. Overall, a automatic tax rate increase just by having the next few years go by. And one thing that Joe Biden did say when he did take office is more or less keep spending is the best way to keep the economy going. If you run through the quote here, and he's not necessarily saying that we're not going to start addressing the deficit. He's basically saying we're just not going to address it right now. So what that should mean to you as you're looking at your retirement and your retirement accounts is, well, what's that going to look like when the government does start to address these issues, whether it's the deficit spending, the national debt. When they start addressing this, how is that going to impact you and your retirement? We look at just the top marginal tax rate as we start looking at what we can start to do to protect yourself. Historically speaking, as we're over here on the right side, historically low tax rates, over 40-year lows, actually. So the question is, when we're looking at it, what's the one thing you can do right now to make sure that you can lower your overall taxes in retirement? And a lot of families take a micro view when it comes to their tax planning. Right? They look at it year to year. Maybe they're working with a CPA or they're doing their own taxes. And how can I look at it and save money this year? Whether it's a deduction that they may be able to take, or whatever it might be. But when we start looking at it, and that's how we look at tax planning here at Secured Retirements, is we look at it more of a macro level, high level, over your retirement, which is going to be 20 to 30 years potentially. How can we make sure that we pay the least amount in tax throughout retirement, not just necessarily year by year, but how can we look at it, again, macro level, high level, through over 20, 30 years? How are we going to make sure that we're going to pay the least amount of tax? And it's not necessarily the easiest thing to look at because it's not the easiest to get undiversified. We talk about tax diversification. I'm sure we're all aware of, we think about investments and diversification. You own some small cap, large cap, growth value, different sectors, and it all kind of works together to lower your overall risk. And it's the same thing with taxes. There's different kind of tax buckets that are out there, and a lot of families that we work with. And again, we go back to when we started our conversation here today. The majority of family savings typically end up being in the IRA 401k accounts. These accounts that they said you can put money in, take a tax deduction, you're going to retire, take it out later on at a lower tax rate. And that's not necessarily going to be the key. So looking at the three buckets, again, majority of families most likely have most of their money for retirement in that tax deferred bucket. That money that's going to be taxed whenever you take it out. And as we sit right now, age 72, they're going to make you start taking some money out via a required minimum distribution. And the question with that is, how great of a deal is that going to be? You have money that's going to be taxed. And again, we talked about the silent partner with the IRS. Is you talk about 20, 30 years of retirement. We don't necessarily know where tax rates are going from here. But given all the spending and stimulus that's been out there, it's got to get paid for from somewhere. And it's kind of hard to look at the math and the numbers on everything and not see how tax rates are going to increase down the road, knowing that there's already a built-in increase with the way that the tax code is currently written. Again, 2026, we're going back to where we were in 2017, automatically higher tax rates, not just regular income, capital gains, dividends, investment income as well. So the question is, how do we start getting as much money from the taxable, maybe the tax deferred bucket, over into the income tax free bucket? And I think everyone on the webinar here today probably would agree that tax free is always better than anything else. So how do we start taking advantage of these over 40-year low tax brackets that we have? Again, historically low where we sit on the left, the 2022 rates here, versus the potential 2026 rates. Now, one thing I will say is the income numbers on the 2026 are not adjusted for inflation. So I would look at it as an example of, the $75,901. Again, this is married filing joint. Start paying tax at 25%. That'll probably reflect something similar to the 22% tax bracket on the left. But again, give or take. But the one thing that really, you look at the rates is right now, married filing joint, you can move with the standard deduction, you can move about $365,000 and pay tax at 24%, where you get to about $80,000 and above here in a few years. In 2026, you're going to be paying 25% of that money. So there's a big opportunity, and there has been, and this opportunity is the window's starting to close a lot faster than it was before. I'm really looking at, how aggressive and should we start to be repositioning some of this money that we've been saving in the IRAs and 401ks, paying tax now at these historically low rates to avoid paying whatever the IRS and the government's going to determine tax rates are going to be down the road. Like, quick example, we'll look at Dave and Sarah. They have $170,000 in income. Again, back to the slide that we just looked at, 2017 tax rates, they're in a 28% tax bracket. 2022 tax rates, where we've been at, they're in that 22. And with that same income, going back to that the 2026 numbers, which is back to the 28% bracket. So we look at just if Dave and Sarah were to convert $100,000 of their traditional IRA to a Roth IRA, a very general example here. Everyone's going to be different depending on their income levels, obviously. But under 2017 rules, they convert $100,000. They're going to be paying close to 33% on that conversion, which is around $33,000 of tax paid on that conversion. We look at what the rules are today. They move $100,000. They're in that 24% bracket. They're only paying $24,000 of federal tax. That's a little over 25% of less tax they paid on that money today than waiting till later on to start taking that money out. Another thing to also consider is this is just the federal tax. If you're like the majority of us here in the great state of Minnesota, we get to tack on another 6 to 10% on this number here as well. If you're in South Dakota, Texas, Florida, this is really the number that you're looking at. But ultimately, there's a big opportunity again right now with historically low tax rates to start moving money strategically from those IRA to tax-free buckets. Once you get money into tax-free, generally speaking, we don't have any more of the required minimum distributions. We get to access the money out of their tax-free at a later date. And really what it does is it takes this risk of higher tax rates in the future off the table for a lot of families that are entering retirement. And I think that's going to be one of the biggest risks that families are going to see as they either transition or that they are in retirement, is their money that they're taking out right now, they're paying less tax on it. But as we start to see tax rates increase over time, which I think is inevitable based on just where we're at and what the current law says. I mean, obviously everything is subject to change every time Congress gets together. But I think it's, kind of more of a matter of time and how high than, them staying the same or going lower. So what can we do? There's a lot of other tax-free options, right? Roth IRAs are one of them, the most common one. There's also cash value life insurance is out there. There's some other tax-free vehicles. If any questions on those, we can dive a little bit more into that. So really what it comes down to is having a comprehensive plan, not necessarily just looking at the investments or the wealth accumulation side of things, but how can we look at creating an income plan, making sure your money's going to last you a lifetime through retirement. Let's then make sure we're looking at the tax return. How can we make sure we take that money back? Let's make sure we take it back as tax efficiently as possible. And then we'll come back to it and we'll look at, okay, how can we grow your wealth? Well, we want to make sure the income and the taxes are planned around first. And then let's look at estate planning, healthcare, long-term care. Let's make sure everything is going to be working together long-term. Again, working together, a comprehensive plan. John here, just looking at your question. We'll kind of run through it. Silver linings. I'd say the silver linings is, the reality is as the deal that was made, everything is going to have to be taxed at some point in time. The silver linings is that we are at a 40-year tax loan. There's a great opportunity to save a 5 to 6 figures in lifetime taxes on these retirement accounts. I'd say that's the silver lining right now. I also think that when we do go back to where, in 2026, I think we're going to be having a lot of the same conversations we're having now, that we're probably going to be in lower tax rates than we're going to be, come 2030, 2035. That'd be the silver lining. Again, any other questions, feel free to schedule some time with the team and look at that. Kurt as well. Again, cash value of life insurance can be accessed tax-free as long as it's structured correctly. Any other, questions on that, we can dive into it with you as well. Mike, with your question, the inflation running, it's a way to look at it, but you look at, inflation where it's at right now. You look at what the Fed is doing in curbing inflation. If we're going to look at it and we're going to run at 9% inflation over the next 20 to 30 years, that could be something to look at. I would look at and make the assumption that we're going to get inflation under control at some point in time in the next year or two. Ultimately, it's going to come down to the tax rate on all the money as well. Inflation, the dollar's worth less down the road. If the tax bill's still higher, it probably is a break even when we start comparing inflation to tax rates. Again, we can run some more numbers and look into it further on that. But, my napkin math, just thinking about it right here, that's probably how I would look at that as well. Kind of wrap up here. Again, we look at tax rates. And the Will Rogers quote here, 2 things are guaranteed in life: it's death and taxes. The only difference, again, death doesn't get worse every time that Congress meets, right? Ed Slott says the tax code is written in pencil. Every time they get together, anything can happen. So making sure that we're being as proactive as possible, looking at what's out there as far as the information and the numbers, where we're heading, and making sure that you're looking at it as an individual basis where you sit. Everybody's plan, whether it's the income, investment, taxes, is going to be different. Make sure you're working with someone, whether it's here at Secure Retirements. If you have any questions, or if you're a current client of ours and you want to review your tax plan and what we're doing, again, to be proactive. If you're not a current client of ours and you'd like to have a tax analysis, give us a call, reach out to the office, schedule some time. We can jump on a phone, a Zoom, or even in-person meeting, whatever works best. and start looking at what can we do to start being proactive and help save you, thousands, if not tens of thousands of dollars, again, lifetime taxes over retirement, specifically around the retirement accounts, the 401k and IRAs. So I don't see any other questions coming in. If there's anything I didn't cover, again, feel free to reach out, schedule some time with anyone on the team here. We'd be happy to dive into it with you. We will be back next week, I think, same time, noon, here online. So I'm sure I'll be sending out what the topic will be here next week. But I'll sign off, let everyone get back to it here today. Hope everyone has a good week, and we will talk to everybody next Monday.